Welcome to this TCA presentation by LMAX Exchange. We've recently published our white paper on TCA and fair execution in the FX markets. We'd like to try and give you a quick overview without referring you back to the whole 84-page document, which we'd encourage you to read. So today we'll try and break it into 4 brief sections for you. Number 1, an introduction of ourselves and the challenges the industry faces, specifically the client challenges. In the second section, we'll look at our evolution of our TCA methodology and a deep dive into each one of the 5 TCA metrics. Then we'll try and put it all together in section 3 with a real-life example. So putting the trader in control and looking at real trades and applying those metrics to those trades and that portfolio. And at the end, in section 4, we'll simply go back to the start and see whether we've answered the questions, answered the challenges that the institutional client faces today. So, very, very quick introduction of LMAX Exchange. I think you're looking at a slide that says that LMAX Exchange, a regulated MTF for foreign exchange, has been an active campaigner to improve transparency and fairness in the FX market. That actually wasn't a modus operandi when we established in 2010. We simply wanted to create a new, more efficient marketplace for foreign exchange. At the time, there was a lot of new marketplaces across all parts of people's lives, be it car buying or insurance or holidays, anything, but certainly financial markets was catching up with these new marketplaces. So that was really why LMAX Exchange established in 2010. Now, the MTF regulation meant that we came with one public rulebook, and a public rulebook that allows all the positive factors such as open access for all, complete transparency, a level playing field, and of course precise, ultra-low latency technology which we write ourselves. So we probably rewrite 30% of our code every year. 70% of all our budget is spent on technology-related factors. So we are squarely a fintech firm. Has it worked? Have we seen any industry traction? Well, I'd like to say yes. Today we have 25 banks as members of the LMAX Exchange and 10 of the largest major non-banks as members. We have clients in over 100 countries, and we have matching engines in London, New York, and Tokyo. So I think this new marketplace has shown that it can work. It's by no means the whole of the FX marketplace. But as we've learnt, as we've developed, there is a need for change, hence why we've issued this white paper recently. Now, we may have been fortunate or prescient, but at the same time we were establishing, the FX market started to face a lot of difficulties. So the FX ecosystem has been under pressure in the past decade. You've seen the scandals, you've seen the fines, the ongoing court cases. Enough is enough. So in 2017, the industry's come up with the FX Global Code, which is all about transparency and having a code of ethics, if you like, for the industry. A code of ethics which we support, and a code of ethics which fits into this very modern marketplace. But then you add in MiFID II, which is coming out in 2018. Again, that's all about transparency, but it brings with it some complexities for the client. Specifically, they've moved the onus of proof, if you like, from taking reasonable steps to taking all sufficient steps to prove the best results when it comes to best execution. So a good thing, a step forward, but perhaps another level of complexity for the client side. So we look at our clients and think there's a simple buy-side checklist. We can overcomplicate this, but truly, what does a client need? They want transparency, which means real, accurate, and relevant market data. They'd like some degree of anonymity. What that means is to ensure their order information isn't leaked to the market in advance of their trade execution. That should be a bare minimum, you would think, for a client. And then at the end, the client really wants to know the true cost of their trading. This is valuable information. MiFID II, you have to be able to demonstrate that. But moreover, you want to be able to understand it, so then you can go and make the informed decision of what you're best at, which is informing you of where, when, and how you trade. Now, we think LMAX Exchange can help you with the first 3. relevant market data, ensure anonymity of your trading, and help you know the cost of your trading through the 5 metrics we're going to go into. So it's an industry prerogative that the buy side is equipped to actively manage their execution quality. It's a very complex, fragmented OTC market. One of our LPs told us today they price over 54 venues. And for the client, they likewise have a whole mix of liquidity, firm liquidity and last look liquidity. And that last look liquidity can have a lot of variables in there. There's also the added complexity of a lack of centralized price benchmarks and consistent timestamping. So we as an industry need to equip the buy side so that they can tick the best X box and make informed decisions. We think the best way to do that is to have an efficient, standardized TCA methodology that covers both styles of liquidity and can be the solution for accurate assessment of execution quality. So the white paper comes up with 5 metrics. And we've tried to overlay that against all the execution factors required by MiFID II. You can probably see it in the slide you're looking at now. At the top, you see the execution factors that MiFID II asks you to answer. So are you getting the best possible result when you consider price, cost, speed, execution likelihood, size, nature of execution, and if that wasn't difficult enough, other execution considerations. So 7 execution factors you must consider. Overlay that against, or put that against our 5 key metrics of fill ratio, price variation, hold time, market impact, and bid-offer spread. We feel if you get the answer per trade for your portfolio for all those 5 metrics, then you can tick the 7 boxes that MiFID II asks you to tick. So how did we at LMAX Exchange arrive at this TCA methodology? Well, we started with a very firm belief that firm liquidity is a better option and last look is a market distortion. But, of course, we've answered the questions for the last 7 years. A lot of clients come to us and say, well, David, your spreads are too wide, so therefore my last look feed must be better. My fill rates are high with last look feeds and as high as yours, so that must be better. I don't get charged commission over here, so last look must be better. Sometimes we win the debate when we play in all the metrics and we show someone the outcome on the portfolio, but quite often we lose the debate. So we started thinking, could we prove our point statistically? So we brought in our smart guys here at LMAX Exchange and we thought we'd try some science. We have a very diverse customer mix. Some are advanced and some are not. So some are very au fait with all these metrics and truly measuring the accuracy and precision of the execution. Some are not. And actually, their degree of sophistication should really be irrelevant to us. We simply need to convince them that one style of liquidity is better than the other. So it's our job to do that. So we thought we'd go away and have a look, and we picked a data set with 7 million trades over the whole of 2016. That fortunately was a mix of firm liquidity from the LMAX Exchange and non-firm liquidity from a range of last look providers. Now it turns out we could have chosen a better data set for LMAX Exchange, but in all cases it was still shown that firm liquidity was better, albeit not to the extent we'd expect. But it's a scientific paper and I think it bears relevance, holds relevance for the whole market. We think that once you get through that white paper and look at the metrics, you should know your costs of trading. You should be able to know how and where to execute. And whether you can prove best execution or not, I'm not sure, but you can certainly prove your execution is fair and tick all the best execution boxes that MiFID II lays out for you. So let's go and have a look at the 5 metrics in detail. Number 1 is fill ratio. Seems obvious, just the number of filled orders as a percentage of the number of orders placed. We at LMAX, though, see rejected orders as an opportunity cost. There's a real money value to a missed order. So looking at the graph below, the first thing we did was just look at market orders. Now you would expect market orders to just have a 100% fill rate, because ultimately the client's saying, I would like to buy please fill me, no matter what happens to the price. So when we looked at it, as you'd expect, right at the top, we were at 99.94%. So near as you can get to 100%. In fact, the only reason you're not at 100% on market order fill rates is because there's a complete lack of liquidity. So for example, someone's asking for 10 million of dollar Hungary at midnight on a Sunday night. But otherwise you get to 100%. So non-100% is really an error. What is odd for us is that people are obviously rejecting market orders. So if you look at Bank 2, they're rejecting 0.5%. Non-Bank 1's rejecting over 3% of market orders. We haven't quite answered that question, but this is what happens on this data set. So then you look at limit orders. Now, you can see we were rather perplexed. Suddenly, LMAX goes to the bottom of the stack. Our fill rate on limit orders was 92%. What's more surprising, if you look, is that you look at the example of non-bank 3, and they've gone from 98% on market order fill rate to all the way up to 99.5% on limit orders. Now that seems counterintuitive. So why would fill rates be higher on limit orders than they are on market orders? It's the same ecosystem. Just doesn't make sense. So please hold that thought. We'll come back to it right at the end when we start looking at the timing of trading and how you put all this together for your portfolio. But fill ratio is TCA metric number 1. Moving on to TCA metric number 2, price variation. Again, pretty obvious, we know what it is. Slippage, so if you're looking at the graph for market orders, slippage would be on the left-hand side and price improvement on the right-hand side. A lot of us would think it would be 50-50. It generally isn't. We see on a true market, i.e. the LMAX exchange, central limit order book, that slippage to price improvement ratio is roughly 2-to-1. You'd expect that through all the providers. Unfortunately not. We saw some results as skewed as 9-to-1. 2-to-1 seems reasonable on the basis that client flow generally follows the wind. So you're buying in a rising market and selling in a falling market. So a couple of things to notice there is that the ratio is not always 2-to-1. Also, if you look at where the lollipop ends on these graphs for Bank 1 and Bank 2 on the slide in front of you, with LMAX exchange, price improvement and slippage goes all the way out. It's normally distributed. So at the end of the spectrum, you can see quite a lot of price improvement, like well above 5 ticks, and quite a lot of slippage well below 5 ticks. But price improvement is seen to be halted at a certain level with the last look providers. Now we move on to, on the right-hand side of your screen, move on to limit orders. Now this graph is actually drawn to scale. The only lines on the graph are LMAX exchange. Why is that? With limit orders, there's no price improvement with last look providers. Doesn't seem to make sense there either. Well, it does make sense. Our liquidity provider will tell me, we don't need to give price improvement, David. Right? We're not a central limit order book. If the market's 2-4 and the client sends me a limit order to pay 5, we fill them at 5. We don't need to fill them at 4. Likewise, if they send me a limit order at 4 and the market blips down to 3, I don't need to fill them at 3. I can fill them at 4. Quite right. That's probably in the execution quality information. But what you see with LMAX exchange is that the blue line almost mirrors, which is limit orders, almost mirrors the red line, which is LMAX exchange market orders. So price improvement is identical for market orders and limit orders. Now look, some of you will tell me that doesn't matter. We can't cope with price improvement. We send an order in to be filled, either fill me or don't. We can't accommodate being filled at a different price. That's okay. We've worked with clients like that. But what I would say to you is please measure that price improvement or loss in price improvement, because it matters when later on we'll show you how to optimize your fill rate. So please try and measure that price improvement, and it's the one big difference between firm liquidity and last look liquidity. Moving on to hold time. Quite a significant subject, this one, in that most central limit order books or exchanges don't have hold time. Our job really is to make our technology work as quickly as possible. So you send an order in, we can match you or we don't. If we match you or not, we tell you as quickly as possible. That happens in equities, it happens in futures. So we spend about 70% of our budget every year on technology, and most of that's about increasing our speed and increasing our performance. So when you look at, this is an example on the screen, when you look at, this was Bank 3, I believe, if you look at this whole time, you'll see that nothing really happens until 83 milliseconds. The first blue peak you see, which is the distribution of fill rates. And then there's another peak around 108 milliseconds, the blue peak again. What's that all about? Well, before I tell you what that is, let's look on the left-hand side. You'll see these red peaks, which are systematic peaks. What that means is you send an order in, there'll be an error of some sort, so probably you've exceeded your credit line or there's no liquidity. The liquidity provider responds to you immediately and says, sorry, can't help you with this order. So it's obvious that the liquidity provider can respond to you. But most of the orders filled happen around 83 milliseconds, or later 108 milliseconds. Why is the two peaks? Well, oddly, this hold time changed on June the 23rd and never changed back for the rest of the year. June 23rd was the Brexit referendum. So there's the hold time. Now, does hold time matter? Well, to one of my clients I spoke to last week, they say no, it doesn't matter because they're aiming for 100% fill rate. So what I'll tell you now is, unless you get 100% fill rate, you must attribute a cost to that hold time. Now, if you go into the white paper, you'll see that we attribute the cost as $25 per million at 100 milliseconds. It's not linear, by the way. You can't just simply bring it down and say, okay, well, my cost at 10 milliseconds is only $2.50. In fact, we see 60% of the cost of hold time happening in the first 10 milliseconds. So make sure you measure your hold time, and that a fill at 100 milliseconds is very different to a fill immediately or in 1 millisecond, as you would expect on the LMAX exchange. To repeat, we have no discretionary hold time. Our 4 nines in terms of execution speeds are 3 milliseconds, and 2 nines normally less than 1 millisecond. Moving on to the fourth metric, market impact. This is actually flavor of the month, and there are 2 reasons why you should consider it. More or less, you should be aware that it is a fragmented market, so information is key. Information is powerful, and the speed of arrival of your order at different venues is very important to your execution strategy. Specifically, first thing to remember with market impact is that execution information received before your full cycle is complete is valuable and open to abuse. I'll show you that in a second with the graph below. The second thing is your market impact will affect your future pricing, and a lot of your liquidity providers will tell you that today. And if you smack the market and the market runs away immediately, it's unlikely you're going to come back to the same market and see the same spread. So this is why you engage 2 types of algos, fast algos or slow algos. You can decide what market impact you want to have. So let's look at the graphs below. 3 sets of data. Top line is our TPA aggregator data, which we studied in the white paper. Very benign flow, very soft flow. You see a marginal decay out to the far end of the x-axis, which is 2.5 minutes. So pretty benign flow that everyone would like to make. You typically expect that set of clients to see very tight spreads. The one below is a broker, and you'll see again slightly lower starting point, but very benign soft flow with limited decay out to 2.5 minutes. Now the one below, which is probably most of you, is an institutional client. So you see very sharp decay where it crosses break even at 100 milliseconds. Very specifically, you'll see a large spike down at 5 milliseconds and another one just after 50 milliseconds. Now, if your execution cycle isn't complete, you haven't had a response back from all your liquidity providers, that early decay is vital for you, and it's costing you money there and then. It's costing you money on those orders. It doesn't necessarily mean, by the way, that anyone's doing anything wrong. It means that someone has received information on your order, they may have filled part of your order, and they go to hedge it in another venue. That means your order has been broadcast to the market and the market starts to react. No problem, as I say, if you've already been filled on 100% of your order. But if your cycle's still going on, going back to the previous metric, if someone is holding your order, which has already been acted on, then it's just going to cost you money. And it's going to result in either a lower fill rate or greater slippage. So market impact, very important to measure and can be measured for every trade in your portfolio. So on to the fifth TCA metric, bid-offer spread. There isn't much to be said here. It seems a pretty obvious metric. Tight spread, good. Wide spread, bad. Or at least that's the way most simple traders look at it, and certainly what you'd be told by last look providers. In fact, you have to add in the other metrics into the spread. It'd be nice for us to be able to get to a situation where you could measure effective spread. So that's the nominal spread, and adding in the positive values from your other TCA metrics, be that the cost of hold time or price improvement, and then get to an effective spread. So watch this space for future analysis of bid-offer spread. I would like to say that the theory holds that last look spreads are tighter than firm liquidity. I'd urge you to take a look at firm liquidity spreads right now on LMAX exchange. I'm looking at 0.1 in Eurodollar in LD4, 0.2 in NY4, 0.2 in TY3 in a million top of the book. Obviously, what's important is to see the spread down the book in full depth, but I'd be happy to predict now that you'll typically see a 1 point spread in 10 million and maybe 1.5 in 20, 30 million at any one time. So, spread is important. It is the fifth key metric, but firm liquidity can also be competitive on spread. So we'll come back to that at a later date. So now, what does it really matter to you? Can we put the trader in control? So back to the first metric, remember? Fill ratio. We were surprised that LMAX ranked down the book at 92% on limit orders. It didn't seem to make sense based on the FX market ecosystem. So we took a deeper look, and the graph you're probably looking at right now shows that indeed on LMAX exchange you see up to 4 times the rate of market data updates that you see with last look liquidity providers. So why is that? Well, the reason is obviously a last look provider doesn't have the defense of last look on firm liquidity. So the only way they can protect themselves is by updating their price more frequently, which causes a lot more market data, which in itself causes a lot of price jitter. So, for example, again, if the market's 2.4, you're willing to pay the 4, you might see it jitter between 3, 4, and 5 within similar milliseconds, because that's the liquidity provider reacting to micro changes in the market. But the good news here is that you can take control of that. So there'd be no point in a client sending a limit order of 5 in that example where the market's 2.4, because the last look provider will obviously fill you at 5, because that's the price you've asked for, rather than the true market price of 4. So it would just cost you money. And to be fair to those liquidity providers, they don't operate clubs. They don't need to fill you at the better price. They fill you at the price you asked for, and you said you were happy to pay 5. Now, with firm limit order books, you can use that tolerance. I'm going to show you on the next slide how you can use that price improvement that we showed you in price variation metric to offset what might start as a lower fill rate. So putting the trader in control using only firm limit orders. This will not work with last look, because as I say, if you ask to buy something at a higher price, they will fill you at a higher price. So with firm liquidity, the client has total control over their execution quality. With last look, the liquidity provider has total control over the execution qualities. So how would that really work in practice? You're looking now at 3 charts. It's the same action. We've just again split it into 3 types of client. A group of brokerage clients, a group of institutional clients, and the clients that come from our TPA aggregated data, which is in the white paper. The top half of the graph is the fill ratio. The bottom half of the graph is price improvement per million. So let's focus in on the institutional client, as that kind of covers everything, and the numbers actually aren't as great as you might see on the broker side and the aggregator side, but they're still very relevant. So the base case, the blue bar you're looking at right now, fill rates for the institutional client base of 82%. Doesn't sound that great actually. So I'm expecting that institutional client would come and say, how do I get closer to 100%? So it's possible. Let's go one step at a time. If you added 2 pips, so it's the amber bar you're looking at now, if you added 2 pips of discretion to your limit order, so that 2, for example, you say, actually I'm happy to pay up to 6 in that example, your price improvement per million would reduce from over $3 per million to now about flat. So it's costing you no extra money to get a fill rate of now over 95%. If you go all the way down and say, well, I want to be as close as I can to 100%, well then there'd be a net cost of negative $2 per million to change your fill rate from 82% to well above 99%. So again, you can completely control this yourself as the client by adjusting your tolerance and your fill rate and taking into account that greater price jitter you'll see when dealing in a central limit order book with more price jitter. So I guess you're thinking, David, that's wonderful in theory. Can you show me the reality? Well, we can. We did it live this year for a broker in Asia. We moved their fill rates from 89% to 97% by just adding 1 tick, so 0.1 of a pip tolerance to their orders at no net cost to them. Now they were the same as many institutional clients. When we started giving them better fills, they said, we can't cope with them. Our back office reconciliation can't cope with better fills. And we said, well, we have to give you the better fill because we operate as a central limit order book. So they didn't really ascribe much value to it, but they accepted that we were giving them a better price. So we persuaded them to try using that price improvement to increase their fill rate. And in real life, they've gone from 89% to 97% this year. So a very good result for both firm liquidity and the client base. So let's look at a set of numbers. Let's look at a base case scenario for you, comparing and contrasting firm liquidity and last look. We thought we'd try an experiment. So imagine that institutional client base with an 81.95%, 82% fill rate as a starting point. The client would say, that's not good enough, I want it to be higher. So with firm liquidity on the LMAX exchange, we'll say, okay, why don't we try a 0.2 pip change and see where the fill rate gets to. So at the outset, you receive $3.44 of price improvement. With a 2 pip tolerance, you pay some of that away, but still end up in a positive territory with 19 cents of price improvement. But guess what? Your fill rate's now gone up to 96%. What's the equivalent with last look? Well, you've had an 82% fill rate. What do? You have to retry. So we've said you retry at 100 milliseconds, which seems to be the average last look time. I know those last look times are coming down, but remember, go back to the hold time metric. 60% of the cost of hold time happens in the first 10 milliseconds. So time is a little bit irrelevant the further out we go. So look, we did a retry at 100 milliseconds. What is the cost to the client? Well, the cost to the client for that fill rate is negative $15. So the difference there for a 96% fill rate between firm liquidity and last look liquidity is $15 per million. Still, the client comes back and says, you, the client, I really, really, really want to get as close as I can to 100%. Okay, so you use half a pip tolerance for that. Suddenly, you start to go into negative territory with firm liquidity, so you decay all your price improvement and you move into a bit of slippage. But your slippage ends up being a net $2 per million negative. but your fill rate's gone from 82% to 99%. The same cost with 100 millisecond retray on last look, negative $18.50. So in this case, again, the difference between firm liquidity and last look, $17. Well, I think the important thing there is that you, the client, the trader, the investment manager is in control. You're in control of your key metrics, and you're in control of what fill rate you get. You don't want to put that control just in the hands of your liquidity provider. So, moving into the final section. Have we met all the challenges of the institutional client that we talked about? Our starting point was effectively that it's very difficult. That demonstrating and proving best execution is near nigh impossible. And people tell me, no, it's not, because you can demonstrate sufficient steps to get the best possible outcome at any one time. Yes, but it's complicated. There's those 7 execution factors, and you must look at all those 5 key metrics. So whether you think best execution is possible or not, what hopefully we've shown is that understanding and controlling execution factors is possible. Fair execution is possible. Demonstrating and understanding your costs and your trading choices is possible. We at LMAX Exchange would like to help. Initially, more practical and advisory. Doesn't matter whether you're plugged into us, that's not the point right now. Our view is that if we improve market structure, then the market becomes more efficient and we can be a part of that, and hopefully we'll benefit commercially down the line. So how can we help? Well, there's firm streamed market data for reference, for benchmarking. Come and ask us for that market data. Depending on who you are, where you sit, we'd be very happy to analyze your own trading data. So as an institutional client, we could run these same metrics against your market data, your real live market data. And we could hopefully show you the true cost of execution using those 5 metrics. Look, commercially down the line, we'd love it if you added LMAX Exchange liquidity into your execution stacks, but that's not the point of this presentation today. The point of this presentation is to try and help the market, advise the market, and educate the market on what they should be looking for in execution quality. So potential future solutions could be that we build an institutional client utility. That utility could include market data. It could have firm-only pricing in it from lots of different providers. There could be TCA add-ons, and certainly there could be a kite mark style certification of best execution demonstration. So we think the time is now. We'd like to start now. Our goals are aligned. Us, who would like to see a fair marketplace, an efficient marketplace, how we started 7 years ago, and you who need to prove it and really just want to be treated fairly. We think our goals are aligned. The goals of the industry with their publication of the Global Code are aligned with those goals of ourselves and our clients, who are now leading the way with TCA and fair execution.